Welcome to StockTok's deep dive into Banco Santander. Banco Santander is one of Europe's largest banking institutions, headquartered in Spain, operating a sprawling global franchise across consumer banking, corporate and investment banking, and wealth management. The bank serves millions of clients across Europe, the Americas, and Asia, making it a bellwether for European financial sector health and credit quality. The stock trades across a 52-week range from $7.41 to $13.24, placing current valuations near the middle of that historical band. As of Monday, May 11th, the stock is trading at $12.20. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Banco Santander generates revenue through net interest income, the spread between what it pays depositors and charges borrowers, plus commissions from wealth management, insurance, and investment banking. The bank's economic moat rests on three pillars: a large, sticky deposit base that funds cheap capital, a century of brand recognition and trust across Spanish and European markets, and significant scale advantages that allow Santander to compete on price while maintaining margins. The competitive landscape is crowded. Regional European banks, global systemically important banks, and fintech challengers all compete for deposits and lending opportunities. Santander's advantage lies in its geographic diversification and retail franchise depth. That said, consolidation pressures, digital disruption, and persistent low rates have compressed industry returns. The StockTok score for Banco Santander comes in at 31 out of 100, signaling caution. Valuation scores 10 out of 20. Financial health scores 6 out of 20. Profitability scores 6 out of 20. Growth scores 7 out of 20. Smart money scores 2 out of 20. This is not a high-conviction name among institutions. Now, valuation. The question every investor has to answer: are you paying the right price? Banco Santander trades at a price-to-earnings multiple of 9.81 times on trailing 12-month earnings. The forward price-to-earnings ratio sits at 10.54 times. Both multiples sit below historical averages for the European banking sector, which has historically traded in the range of 12 to 15 times earnings. The PEG ratio, which divides the price-to-earnings multiple by expected earnings growth, comes in at 1.43. A PEG below 1.0 typically suggests a stock is undervalued relative to its growth prospects, though Santander's modest growth rate keeps that interpretation muted. The price-to-sales ratio, which divides market capitalization by annual revenue, stands at 2.75 times. The EBITDA multiple, earnings before interest, taxes, depreciation, and amortization, cannot be meaningfully calculated for banks because their capital structure and accounting make traditional EBITDA less applicable. The economic moat we outlined, scale, deposits, and brand, supports a valuation premium to peers in stable times. However, we must ask whether current multiples reflect that moat fairly. At 9.81 times earnings, the market appears to be pricing in persistent margin compression, elevated credit losses, or slow growth. That may be deserved caution given the macro backdrop. Wall Street analysts tracking this name have a consensus mean price target of $12, with a high target of $14 and a low target of $9. That consensus target of $12 implies minimal upside from current levels, roughly flat. The margin of safety, the difference between fair value and current price, appears thin. Our view is that fair value for Banco Santander sits in a range between $10 and $13 per share. Taking both the analyst consensus and peer valuation context together, the stock does not appear substantially mispriced, but neither does it offer compelling margin of safety. The upcoming earnings date on July 22, 2026 will be an important catalyst to watch, with consensus expecting earnings per share of 0.30. Market sentiment around Banco Santander leans neutral, with insufficient recent news to drive directional conviction either way. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist measuring the quality of a company's balance sheet and cash generation, comes in at 5 out of 9 for Banco Santander. That score sits in the middle range, Not alarming, but not robustly healthy either. The Altman Z score, a bankruptcy risk model that weighs profitability, leverage, liquidity, solvency, and working capital efficiency, registers at 0.00. For context, a Z-score above 2.99 typically signals low bankruptcy risk. A score in the distress zone, below 1.81, warrants caution. Santander's 0.00 reading reflects the structural differences in how banks are modeled versus manufacturing companies, but the model's output suggests elevated financial risk. Let's examine the specifics. Santander's cash-to-debt ratio stands at 0.83, meaning the bank holds 83 cents in liquid cash for every dollar of debt outstanding. That is a modest ratio. For a bank relying on deposit funding, a higher cash position would provide more comfort. The debt-to-equity ratio, which divides total debt by shareholder equity, is 3.10. Translation: for every dollar of equity, Santander has $3.10 of debt. In banking, leverage is structural and necessary to fund lending, but that ratio signals meaningful dependence on debt markets. Interest coverage, the ability to service debt from operating income, cannot be precisely calculated with the data available, but the combination of modest cash position and elevated leverage suggests moderate stress potential in a rates shock or credit event. The verdict on financial strength. Banco Santander's balance sheet is not distressed, but it is not fortress-like either. A bank carrying 3.1 times debt to equity faces meaningful refinancing risk if funding conditions tighten or depositor confidence wavers. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or ROIC, measures how much profit a company generates for every dollar of capital deployed. Santander's ROIC cannot be precisely calculated from the data available, but it is a critical metric to track. What we can see is the margin stack. Gross margin, not applicable in traditional banking models, and operating margin, also not standard for banks due to their different P&L structure, are not quoted here. Net margin, which divides net income by revenue, stands at 27.41%. That is a healthy number on its surface. Santander retains nearly 28 cents of profit for every dollar of revenue generated. However, the picture darkens when we examine free cash flow margin, free cash flow divided by revenue, which registers at negative 38.42%. That is a significant warning sign. A negative free cash flow margin means the business is burning cash relative to revenue. For a large bank, this can reflect timing of loan vintages, deposit funding cycles, and one-time charges, but persistent negative free cash flow suggests the earnings are not translating into actual cash generation. Return on equity, which divides net income by shareholder equity, comes in at 15.77%. That is respectable above the cost of equity in most scenarios. Return on assets, which divides net income by total assets, is 0.88%. That is quite low. For every $100 of assets the bank holds, it generates less than $1 of annual profit. That reflects the thin margin nature of banking and the leverage required to earn returns. The profitability verdict. Santander reports strong net margins, but free cash flow is negative and return on assets is anemic. The earnings are real, but the cash generation is questionable. On to growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years comes in at 3.40% annualized. Over the trailing 5 years, revenue grew at 9.10% annualized. That acceleration from the 3-year to 5-year rate is notable. It suggests the growth trajectory has decelerated materially in the more recent period. 3.4% annual revenue growth is below nominal economic growth in most developed markets, which means Santander is losing market share in real terms or operating in a structurally declining sector. Book value growth, the growth in shareholder equity, over the trailing 3 years is 9.80% annualized. That outpaced revenue growth, driven by retained earnings and prudent capital management, but it also suggests management is growing the equity base faster than it is growing the top line. That is a defensive posture rather than an expansive one. The dividend yield stands at 2.11%. For context, Santander is returning cash to shareholders through distributions, but the yield is modest relative to what a mature, low-growth bank might offer. Management has not signaled accelerating growth initiatives. The earnings per share estimate for the next reporting period is 0.30, flat to the consensus range. The growth verdict: Banco Santander is a slow-growth, mature institution. 3% revenue growth is below inflation in most of its markets. Book value is growing faster than revenue, which signals capital accumulation without corresponding business expansion. Dividend yield of 2.1% is a modest sweetener, but does not change the slow growth narrative. Now let's talk smart money. What institutional capital is actually doing with this name? 7 top-tier investment gurus currently hold Banco Santander in their portfolios according to available holdings data. That is a meaningful number. It suggests some sophisticated capital has conviction in the position. However, the broader institutional buying signal is weak. Only 4.2% of 13F institutional filers. The quarterly holdings reports that large asset managers file with regulators are net buyers of the stock, meaning they are increasing their positions. Anything above 50% would signal broad institutional bullishness. At 4.2%, the picture is one of institutional indifference or slight selling. Insider ownership stands at 3.11%. That is moderate, neither exceptionally high nor dismally low. Insiders do have skin in the game, but 3% is not so concentrated that it signals major confidence in near-term upside. Insider transactions over the last 3 months show 0 buys and 0 sells. That flat activity suggests insiders are neutral on valuation and near-term prospects. They are neither accumulating at a discount nor liquidating ahead of deterioration. The smart money verdict: 7 gurus believe in Santander's long-term franchise value, but the broader institutional complex is not rushing to buy. Insider inactivity signals management is comfortable with current valuations but not excited. This is a stock that attracts value-oriented long-term holders, but not growth-chasing momentum capital. And finally, the verdict. Let's bring it all together. On valuation, Banco Santander trades at 9.81 times earnings with a fair value range we estimate between $10 and $13, offering limited margin of safety at $12.20. On financial strength, the balance sheet carries meaningful leverage at 3.1 times debt to equity, with only modest cash relative to debt obligations, and a Piotroski score suggesting middling health. On profitability, the bank reports respectable net margins of 27% but negative free cash flow of negative 38%, indicating earnings are not translating cleanly to cash. On growth, revenue is expanding at only 3.4% annually, below nominal growth in most developed markets, while book value compounds faster than sales, a sign of defensive capital management. On smart money, 7 gurus hold positions, but institutional filing activity and insider behavior are both neutral to negative. No urgent accumulation by sophisticated capital. In our view, a fair value range for Banco Santander sits between $10 and $13 per share, representing roughly flat to modest upside of approximately 3 to 8% from current levels. The bank is not broken, but it is mature, slow-growing, and leveraged, a classic value trap waiting to happen if credit cycles or funding conditions deteriorate. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Banco Santander. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.